Hey guys, Amy Winchettle with the Del Real Group here. You know what time it is. It's time for our market update for Stanislaus County. Let's get right to it, starting with inventory. Here we're looking at inventory, the available homes on the market continuing to drop. We're seeing the transactional recession that we touched on in the end of year recap still happening. We did see rates dip down again. Remember, sales or closed transactions are a lagging indicator, so anybody that's locked in their rate 30 to 45 days ago become closings this month, so you'll start to see that number surge up. Pending sales are up. You could see the red pending line surge up on transactions, so I'm expecting closings to be much higher next month. Right now, we're seeing a lot more activity in the market. When it comes down to days on the market, we're sitting currently at 45 days, which is slightly higher than last month. So again, buyers have a little bit more time to select properties in certain price points. Keep in mind, certain price points move a lot quicker with the buyer activity that we currently have. Rates going down from 7% to 6% this month, we're starting to see more activity. Now that we don't have a ton of inventory, so it's something that will require patience from the buyer if the right property doesn't pop up. But at the same time, if it's under the lower part of the median price point, or priced appropriately in good condition and location, you're probably going to have to move quickly to lock it in because you're seeing an increase in activity there. Moving on to the median price point. You'll see we're down 3.5% within the first 30 days of the year. Now I have a feeling this, with the surge of activity again, the rate and the season being a transactional recession, having a low number in November and December, I was expecting a lower price point for this month. But I feel like next month you're going to see that number surge back up and maybe recover some of the loss for January because of the pending activity. We're down 10% in the last 12 months and 14.5% from the peak in April. Now remember that we talked about in our previous updates. Payment is price versus terms. The buyers that bought 14% higher compared to the price right now have a lower mortgage than the buyers today. So over a 30-year period, they're going to pay a lot less. And that is the demand destruction that we have been talking about. What that looks like is regardless of whether you're paying 14% lower for a house today or 10% in the last 12 months, but the rate is 2 to 3% higher, you're seeing an increase in the mortgage payments. So neither the buyer nor the seller are really winning. Sellers are selling at a lower price point and the buyers are paying at a higher mortgage payment. Now that the rate is coming back down, you'll see the surge of activity. A lot of buyers wait till the beginning of the year for their New Year's resolutions, let's go buy a house, which has put pressure on the fact that the cost of housing is going up and rents are going up because of the inventory struggle and because of the affordability destruction. Equity for the average homeowner in the U.S. today is increasing. It's at 58%, and the surge of prices, the restructuring of debt has caused a lot of this equity. As you can see, equity increasing year over year, 2022 is the highest it's been. So it's safe to say the U.S. housing market in general is fairly healthy other than the lack of inventory. Lack of housing for the demand that we're seeing in the new household formations. As for the absorption rate, we haven't broken that ceiling of 2.7 months of inventory. We've become close to it, currently sitting at 2.5 months, but we have not broken it yet. We'll see what happens throughout the year. Remember, a normal market is 4 to 6 months of inventory. Let's look at that for a moment. With the number of transactions surging up and the inventory dropping down, I have a feeling that next month we might see the number come back down. I've also included other important slides, again, 58% equity that we talked about earlier, which is a healthy state for the U.S. market. Recession is coming. This is something that we must look at. The recession is coming. There's a credit card debt. You could see after COVID, we've seen an increase in credit card spending. A natural revolving debt is getting higher and higher. Personal saving rates are also getting lower. You combine that with the potential loss of jobs and a recession, that could sting a lot of current homeowners right now. Now, the good thing is that they have the ability to sell because with 58% equity, they have options compared to what it was like at the beginning of the recession in 2008, where they had less than 19% equity. But right now, homeowners are sitting with great terms, they're sitting with a lot of equity, and when their options with renting aren't any better than the payments that they have right now. Traditionally, with homeowners now, it's most likely going to be higher with rents. Home price moderations. Over the last couple of years, you could see prices have gone up consistently. Buyers, this is what we mean when we say build your wealth in real estate. Now, you are seeing a slight pullback here, not really the recession, crash, or correction though. But again, we're seeing a surge of activity, so we'll see if that continues down more or if we're finding a resistance and we're going to go bounce back up or at least stabilize and become a little bit flatter. Shelter costs is 39% of core CPI, Consumer Price Index numbers. Another thing that we must look at, the cost of living is a big deal. Shelter costs on the monthly mortgage obligation increased by 17%, and that affects the CPI numbers. Rents have been going up as well. There's not a lot of housing out there. That also is affecting the CPI numbers. It's coming down all the way across the board with food, gas, clothing, and other things like that, but we're going to wait to see what that tells us and whether we're going to go into a full-out recession and what that does to the housing market. But that's a wrap for your January update. I hope you found this information to be helpful. Please feel free to share and spread the word with anyone you think that this would benefit, friends, family, coworkers. If you have any questions regarding how much your home is worth in today's market, or if you're a buyer or future buyer and would like to know more about the buying process and or talk winning offer strategies, please don't hesitate to reach out. I'm more than happy to help. Until next time, see ya.